If you want to become rich as an investor, you need to know what a stock is and how it works. Stocks are one of the best ways to get rich, and an important term to understand if you want to become an entrepreneur. In our previous videos, we have covered some important but basic topics that have led us to this video. Investments in stocks is a common way of investing, and one that has great historical returns. But what is a stock? How do stocks work? How does the value of a stock increase or decrease? In this video, we will answer all these questions and show you how people can get rich from stocks. Welcome to Investing in a Nutshell, the channel where we explain the world of investing so that you can learn and start your own journey as an investor. In order to understand what a stock is, we need to talk about ownership. Stocks are a representation of ownership in a corporation. If you buy a car, you are registered as the owner of that car. You own 100% of your car. The same way, if you buy an apartment with your spouse at a 50% ownership each, you own one out of two parts of the house. Companies or corporations also have a structure for representing ownership. It needs to reveal who owns the company and how much each of them own. A company is divided into a set number of equally large parts called shares. Every share represents an ownership in the company. In a nutshell, that is what a stock is. You own part of a business. You divide the number of shares you own by the total number of shares that exist in order to determine how large your ownership is in a company. But how do you know the value of a stock? How does a stock rise or decrease in value? Let's start a new company together, selling lemonades in the neighborhood. You start the company with $1,000 and decide to split the ownership into 100 shares. Each share now represents a 1% ownership in the company and has a fair value of $10 each. As the founder, you keep all the shares yourself, and as of now, you are the only owner of the company. In order to sell lemonade, we need to make some initial investments. You buy a stand, a big batch of lemons, sugar, and cups for serving the lemonade. This will cost a total of $500. Your lemonade stand becomes popular, and you are able to generate a profit of $200 per month. After 2 months, your business has made a profit of $400 and has a cash reserve of $900. You want to scale your business further and launch 5 more lemonade stands. This requires capital, and therefore you reach out to a friend who loves to invest in promising businesses. Your friend is impressed with your numbers, and you agree that a fair valuation of the company is $10,000, which means $100 per share. You sell him 20 shares for a total of $2,000 that you put into your company in order to buy more lemonade stands. The company now has $2,900 before the expansion. You still own 80% of all the shares, and your friend has the remaining 20%. You are now able to set up 5 more lemonade stands. If the new lemonade stands are equally profitable as the first one, you will produce $1,200 every month in profit. That is more than your initial investment into the company in the first place. This was a very simple example of how to value a stock. With large companies, it is a little more complicated because there is a lot more information to evaluate. But in essence, the value of a stock is whatever any buyer is willing to pay, which is usually based on the performance of the underlying business. If the business does well, the stock price increases. As a stock owner, you own part of the business. We just described how a stock in a company is valued, but the shares you own will also entitle you to some rights. You have the right to attend the annual general meeting, which is the company's supreme body. At this meeting, you can vote on various subjects, like who should be on the board of directors. You have the right to both attend the meeting and also to vote with the number of shares that you own. There are a few exceptions. Some companies have different stock classes, where only a few of them have voting rights or the right to attend the general meeting. But for most companies, they will only have one stock class, and these shares all give the same rights. As a shareholder, you also have the right to your part of any dividends the company pays out. Dividends are one way a company can give its owners part of the profits it has generated. Essentially, you get a fixed amount of money per share you own. We will cover dividends in a future video, so make sure to subscribe to the channel and press the like button. It really helps out the channel. It enables us to reach more people and help them start their investment journeys. If you own a large portion of the company, you will get more rights. For instance, you can suggest board members for the annual general meeting. In our lemonade stand example, we briefly covered the value of the company and how you can use this to calculate the value of the shares. If you know the share price, you can multiply with the number of outstanding shares to get the current value of that company. If you know what you think is the fair value of a company, you can divide with the share count to get the share price you think is fair. But how is the value of a stock decided? How does it move up or down or sideways? In essence, the price is based on what the market decides the current fair value to be. The price listed is always the agreed price for the last completed trade. Once the stock exchange finds a seller and a buyer with the same price for the company, a trade is performed. The price will go down if investors who want to buy the company don't want to pay as much, and the sellers of stocks are willing to lower their prices. The opposite way would bring the price up. Most large companies on the stock exchange have thousands or maybe even millions of shares traded every day. For these companies, you can always assume that the shares represent the fair value of the company assigned by the market at that moment in time. For very small companies with only a handful of trades a week, the listed price might be misleading. The listed price is the price on the last completed trade. But what if all buyers lowered their offer by 50%? The listed price is the same, but you will not be able to sell your shares for any price close to the listed price. Think twice before investing in companies with a very low trading volume. The listed price might not be the fair value of the company. So we have covered stocks, what they are, and how they are valued. But where can you buy stocks? There are broadly speaking two types of companies. The first one is companies listed on a public stock exchange. Most large corporations are on one or more stock exchanges where anyone can buy a piece of the company. The stock exchange will be the handler of the trade and match a buyer and a seller. Institutional investors and large hedge funds can perform trades directly with a stock exchange. For us retail investors, we need to use a platform to help us perform the bidding toward the stock exchange, known as a stockbroker. In the US, there are several big platforms: Fidelity, eToro, Robinhood, Webull, and many more. Use Google to find a stockbroker that works for you. The other type of companies are companies not listed on a public stock exchange. These companies are what is known as a private company. Most companies start as private companies and then get listed on a public stock exchange once they reach a certain size. Some companies are even on the stock exchange for a time, and then are bought up and removed from the stock exchange, like Twitter. Twitter has been bought up by Elon Musk and a few other investors. In the US, there is a limit of 2,000 investors for a private company. It is often difficult to buy stocks in private companies because you need to find someone who wants to sell stock, agree on a price, and perform a transaction all by yourself without a platform that can do this for you. In summary, a stock is a piece of a company and represents your ownership of that piece of the company. The stock will grant you some rights, like attendance to the general meeting, voting rights, as well as rights to some of the profits in the form of a dividend. The price of a stock is decided by the market and represents the market's value for the whole company. You can buy publicly listed stocks using a stockbroker, like Fidelity, eToro, Robinhood, or Webull. Companies and their corresponding stocks have made many people rich over the years. Find a company you think is worth a lot more than the current stock price suggests and invest in that company. If you're right, the stock price will eventually rise, making you rich. We hope you have enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. Have a great day, and good luck on your own investment journey.